of Bloomberg Intelligence. Joining us now to carry on the conversation, Bilal Hafeez of Macro Hive. Bilal, I want to kind of conflate what is happening in the market and what is happening in the real world. Everybody's getting very excited about vaccines, as a result of which we've seen a significant rotation back into value stocks. Travel stocks have been bid, energy stocks have been bid. Are we getting too granular, though? What are we missing? Is the market being myopic?
Yes, I mean, I think it is, because I think what the market is not taking proper account of is some of the structural and enduring supply side consequences of this year, 2020, because not only should we kind of care about the COVID second waves and, whether you should buy value or cyclicals or not, we need to think about how is society and the economy going to be re-engineered, given that for much of 2020, most of the world was stuck at home, having to change their jobs to work remotely. And I think this has some quite enduring and profound effects on how society operates, how the labor market behaves, where people live. Do they live outside of cities now? And I think this is really the thing we need to focus on now.
Well, Bilal, how do those societal changes then translate into changes in an investment thesis? What are the actual tangible financial market impacts of people living in the suburbs and not in the cities, for example?
Well, for me, the biggest and most consequential one is its impact on inflation. There's a big debate amongst investors right now about whether we're going to see a breakout in inflation higher or whether it stays low. And the general consensus seems to be moving towards inflation will end up moving higher once we get the vaccine, because of all the printing of money and high debt and so on. But my contention is that I actually think that because of these supply side forces, inflation will, if anything, stay low, if not fall lower from here onwards. Because I think that if you look at the bulk of inflation numbers in rich countries, it's made up of the service sector, services, products and services, which makes up most of the inflation measures. And it's really these areas that are seeing the most profound structural changes. So whether that's health costs or education, on the education side, is it possible now for schools to charge as much as they used to, given that there's a possibility of remote teaching? For much of this year, if you didn't have COVID, the way you got treated was over the phone or through video calls. And so that's going to have a big kind of impact on healthcare services and the costs related to that. And then on the housing costs, which is a big component of inflation, if people move out of expensive cities and move to sort of cheaper, lower rent areas, that will also have a negative impact or lower impact on inflation as well. So for me, the big one is inflation.
If there is no inflation, do I stick with tech?
Yeah, I think you still do stick with tech. And the reason you stick with tech is, one, because the underlying driver here is the rapid and widespread adoption of technology that's leading to these supply side changes, which again is positive for tech in general. But the other side is that it also means that central banks are going to keep interest rates very low for long. And we know from the experience of this year and the year before that low rates generally help cash-rich tech sector companies, unlike, say, the dot-com period where they weren't generating profits. This time they are. So they're one of the most attractive investments you can make where you can earn some kind of yield.
Well, Bilal, you mentioned lower for longer rates, and I have to wonder how much of the ongoing virus, the eventual vaccine, really matters so long as the Fed has the markets back on that front.
No, that's indeed true. To some extent, the Fed stays on hold, it almost doesn't matter what's going on elsewhere. That said, there is an interesting dynamic of which regions benefit. So you could have a scenario where the Fed keeps rates low, but you don't invest in the US or in Europe. Instead, you just invest in China or in emerging markets. I mean, that's something we saw after the 2008 financial crisis, where there was a massive flow into emerging markets. So I think the fundamentals do matter as to which risk markets you invest in. So that's where it does matter. But the overall risk sentiment, I think you rightly point out, a large part of it just depends on whether the Fed keeps rates low.
Surely what you're suggesting, though, will be potentially inflationary for hard assets and commodities in particular. I've seen copper shoot higher. Oil is moving higher as well. We're likely to transition away from oil. But in the meantime, if people move out of big cities, they're likely to drive cars more. If we are going to see people moving out of cities as well. Electrification is going to be an ongoing part of the narrative as well. We're going to be upgrading a lot of the infrastructure in the more remote areas. Are commodities going to be a beneficiary of this low inflationary environment?
Yes, absolutely. I think it will, and I think this is one of the ironies of the big, climate change and green energy movements, is that the infrastructure you need to build this green energy grids requires a lot of old-fashioned hard materials, copper, mining, and fossil fuels to sort of create that infrastructure. But I do think that there will be big demand for commodities in this environment, and of course, we're seeing that already with copper, iron ore. Even soybeans on the ag side. Now, part of that also is to do with China, because China has really, continued to power ahead over the course of this year. And more generally, if you look at the segment of the economy that has done very well this year, it's manufacturing. Manufacturing has kind of hummed along relatively well, whereas the service sector that has really taken the big hit. So sort of manufacturing commodities, they're all kind of connected together. And so I do think that there will be kind of a continued upward pressure on those markets.
Bilal, stick around. Plenty more to discuss. Bilal Hafeez from Macro Hive staying with us. This is Bloomberg. Brilliant. Thank you very much indeed. Let's get back to our conversation with Bilal Hafeez, Macro Hive CEO. Bilal, stocks have had an amazing month, possibly one of the best on record. Yet during that period, bond yields have barely budged. Can we talk about the sustainability of a value rally if we don't see yields moving significantly higher?
Yeah, no, that's kind of a very, very good point. I mean, if you look at what was driving particularly US yields higher from the summer months up until early November, I think much of it was related to a possible fiscal stimulus on the US side. So there's kind of different elements to what's driving US yields or yields in general higher. Part of it is a cyclical story, but that is to some extent suppressed by central banks saying they won't do anything. But the other is the fiscal side. And my sense is it's really the fiscal side of the story that's really driving yields here. So in order for yields to go up, we would need to see some signs that there will be a larger fiscal stimulus on the US side. Leaving that aside, you could still have an environment where yields go sideways, yet cyclicals still perform well and the value trade still works well if the economic data and the prospect of the vaccine it still remains with us. So you can have this disconnect between the two. And the main reason is because the central banks are essentially saying, there may well be a recovery, but we won't do anything. So that stopped yields from going up.
Bilal, you mentioned fiscal, so I have to ask you about it. How much do you think the market has already priced in that fiscal stimulus happening, and therefore how much of an upside catalyst do you really think it could be?
No, yeah, that's a good question. I mean, I think it depends which part of the world we're talking about. So in Europe, I think there's quite significant fiscal stimulus priced in. We heard recently this week that Germany is going to increase its fiscal spend for next year. The US side, my sense is the investors have dialed back their expectations for fiscal stimulus after the US election results, which at the moment at least show that the Democrats haven't been able to capture the Senate. Now, of course, we get the Georgia runoffs in early January that could change the picture. But my sense is, and at least when I speak to most investors, they are not expecting the Democrats to capture the Senate, which therefore means that they aren't really expecting much for fiscal stimulus on the US side.
Bilal, you sent me a chart. You sent me a note earlier on with 8 charts that we should be thankful for. Which is your favorite?
Well, there's a bunch of sort of favorites there. Perhaps my favorite one was the first chart, which showed that, pollution levels, however you measure it, nitrogen oxide, the emissions from cars to carbon all fell dramatically this year. So that kind of shows you that, while we have all suffered from, the vaccine this year, planet Earth has had a break from all the pollution that humans have imposed on the planet. So that's been a big kind of improvement over the year. And, one hopes then that, we kind of can appreciate some of the measures we can take to reduce the pollution going forward, and if someone had told you have to stop all your movements, people would have said no way. But now that we've learned that we can actually reduce, our movement around the country or to other countries and still have see a balanced life, then that I think could be quite promising for the future.
Bilal, quickly, do you see on that same note that 2020 push toward ESG sticky?
Yeah, absolutely. I do think that that will be the case. I mean, at least in Europe, there's still a huge push at policy level. So in terms of regulatory, push, infrastructure spend, Europe is kind of leading the pack here, and that will push, the ESG agenda. Plus also on the US side, the Biden administration, I think, will be very much, pushing a climate change agenda. And so that will also provide an impetus on the US side as well.
All right, Bilal Hafeez of Macro Hive, thank you so much for your time today. Happy Friday.